Hello, this is Matthew Copley with Copley Financial Group, and today we're going to do a market update, and it's been a little while since we did one. Nothing has really changed on our forecast. We think the market is still in a downtrend, as I mentioned on the last market update. Our targets have not changed. We are hoping to hit those targets so we can get more aggressive on the accounts and be able to pick up some good returns on a rebound. Now, that said, I want everyone to understand kind of the thought process behind this, and we've been getting some calls of clients that are concerned about the stock market and how the market's down, and they're worried that maybe they should, sell and go to cash. I need you to understand that holding cash at this point is the risky position. And the reason for this is understanding how markets work. Obviously, the stock market's way down this year, and you typically, on a down market, want to buy in. You want to buy low and you want to sell high. That's what you want to do with the stock market. Now, we know based on market performance, based on inflation and everything else, the stock market's going to be a lot higher in 5 years, in 6 years, in 7 years. The stock market's going to be a lot higher than it is today. So the risky position is to hold cash right now. If you really wanted to be super conservative, you'd put all your money in the stock market, know that it's going to be higher in 5, 6, or 7 years, maybe even sooner. So that is a sure bet. It's a safe bet. Holding money in cash is risky because the stock market could take off and start getting some good returns, and you could be sitting in cash that's losing value because of inflation. And we know inflation is going to be a lot worse than they're telling us. And I've been mentioning this over and over again about inflation. It's going to continue to be worse than expectation. The market is totally off. They're pricing in inflation at very low levels for next year, and it's going to be a lot higher. So I do agree that we're in a recession now and that inflation is going to come down because of the recession data, but it's not going to go down as much as everyone thinks, and it's going to pick up and get worse, especially if the federal government pivots and stops raising rates. I think September this month may be the last of the big raises, and we probably will get 75 basis points because this is what everyone's expecting, and the Fed typically likes to do what everyone expects. But they may surprise us next month with a much smaller increase or no increase at all. And because of that, I think that holding cash at this point is a pretty risky proposition, because that's where the bubble is. The bubble is in cash. So much money is in cash right now. And you don't want to be the last person holding that cash when the markets and inflation really take off. So we're still holding that cash because we think our targets are going to get hit. We think we're going to get into a good position to buy more cheaper. And so we're in a little bit more aggressive position by being more conservative at this point and holding that cash. But we do plan on getting more aggressive with the stock accounts as soon as that opportunity presents itself. Now, as far as inflation, we've talked about supply chain and production and some of the stuff in the previous videos. One other thing has really come front and center, and this is the BRICS. And they may not be talking about this in the mainstream media, but it's something that I'm following very closely. And this is a group of countries that have gotten together, and their objective is to get out of the US dollar system. And this is Brazil, Russia, India, China, and South Africa. They're commonly called the BRICS nations. Now, these countries, they want to get out of the US dollar and off of our payment system. And my response in the past, whenever I've heard this, is who's going to trust Russia or China over the United States? Well, we're getting to that point where we may be there. One of the big concerns I have is some other countries have announced that they may join the BRICS, and when they announce they may join, it means they're probably going to, and that's Egypt, Turkey, and the big one is Saudi Arabia. If Saudi Arabia joins the BRICS nations, we have a real problem. The main reason the US dollar has such a strong reserve around the world is because Saudi Arabia is selling all their oil in US dollars. Now, they do have one channel to China where they're selling oil to China on a limited basis, and China is giving Saudi Arabia some Chinese bonds, which they can convert to gold and send the gold back to Saudi Arabia or hold it in vaults there in Shanghai. So there is one avenue, but it's limited. If Saudi Arabia all of a sudden joins the BRICS and says, hey, we'll take rubles and won and euro and whatever we want in oil, some of those dollars around the world are going to come flooding home because we're not going to have those countries needing dollars to buy oil from Saudi Arabia. And this could be a domino effect around the world. And if a lot of dollars around the world start flooding home, this is going to make the inflation problem even worse. So I'm watching it very closely. I'm watching what Saudi Arabia is doing. I'm watching what's going on. I actually think that the trip that Joe Biden took to Saudi Arabia wasn't about begging for more oil production. I think it was a trip to let Saudi Arabia know that if they join the BRICS, they're probably going to end up like Libya and Gaddafi. That's my conspiracy theory that I think probably is what took place. They don't want Saudi Arabia to join the BRICS, and this is a potential issue that we're following. So obviously, all roads lead to inflation. This is where the concern is. So that's why we're positioned the way we are. And I do want to get more aggressive on all these accounts when the timings are right and be able to take advantage of that. And so that's kind of where we're at. Now, what else can we do if you have money sitting in cash and you just say, Matt, I am scared. I don't want to put money in the stock market, even though 5 years from now it's going to be a lot higher and it's probably the best place to be. Well, it's at least do something other than have it sit in the bank earning 1%. There's some great rates right now. We have things called multi-year guarantee annuities, and we have rates that are higher than I've seen in years on these things. A current 3-year annuity, and this is just like a 3-year CD. You put your money in, you get guaranteed interest for 3 years. They're currently paying at 3.95. We have a 5-year annuity at 4.4%. This is guaranteed 4.4%. So this is a lot better option than just sitting doing nothing. So if you do have a bunch of cash and you just say, Matt, I don't want to put it in the stock market. I don't want to take that risk. I can just want to get guaranteed interest. Well, there's an option for you. Also, that buffered index is still looking good. As I expected, the cap rates have come down a little bit, but we're still getting a 33% cap on a 2-year buffered index. That's a potential 16.5% annual gain with that insurance, the dual directional, the buffered index. So obviously everyone who has their current buffered indexes renewing, we're going to be putting those people in the new offering, which is great. And we're going to be looking at all of our existing client accounts, see if there's an opportunity for existing clients to put more in those. Obviously reach out to us if you have any questions and want to do that. That's definitely a great investment right now. Allows you to invest in the stock market, get some gains with some insurance. In case the market goes down, you get reimbursed. So those have obviously been working great for us with the current market environment. With the stock market down, we know when we hit those anniversary dates, we're going to get reimbursed. So makes the downturn a lot easier. One other thing I want to mention is tax reduction. We're coming up to that time of the year where we're looking for opportunities for people to reduce their taxes. And if you happen to be an accredited investor, this is our clients that have $1 million in net worth outside of their house, and they qualify, and this includes all the value of their rental properties and stocks and everything else, if they're worth $1 million outside of their house. We have some strategies, and there's some really unique stuff this year that's available. I'm going to do my best to reach out to all of our clients that are in the higher income levels to potentially get some serious reduction on their taxes. Give us a call if you're in that position. We want to make sure that you're on the list, and I want to be able to provide some of those options. Some of them have requirements where you have to be an active real estate professional or active real estate investor. Other ones, you have to put your money into a various investment for a period of time. But there's some unique stuff out there this year to reduce taxes. I'm going to be doing a lot of this personally, and if you are an accredited investor and you want to talk about reducing your taxes this year, now is the time to start doing that. So hopefully that was a good market update and some good information about what we're doing and what's going on. Feel free to call the office if you have any questions about what we talked about here. And I will have our marketing department send out an email specifically on the multi-year guarantee annuities, what the current rates are. I know that people are really interested in that now with these higher rates that are available, and they may not last. If the Fed pivots and rates come back down, well, grab them while you can. So we'll get an email out letting everyone know what the current rates are that they can take advantage of.